Welcome back to Module 2 of the Blueprint course. In Lesson 7, we are diving into the key elements of a trade and introducing you to our set approach: stop, entry, and target. You will learn everything you need to know about setting up your trade, from choosing the right entry, placing in an effective stop, and defining your target. We will also explore different types of entries and, as always, bring it all together with a practical application session. Let's get started. Before we dive deeper into trading strategies, let's focus on the core components of every trade. Many of you may have experience buying stocks, ETFs, gold, or even Bitcoin. But successful trading requires more than just buying and selling. It demands a structured plan. Every trade consists of three essential elements: stop, entry, and target. First, stop. Limiting losses. Your stop is where you exit if the market moves against you. This is your safety net. Without it, small losses can spiral out of control. Every professional trader uses a stop. A stop is the most important element of a trade, and that's why we also talked about it first. Second, entry, the starting point. Your entry is where you open a position at a predefined price, not just anywhere. Anyone can jump into the market, but smart traders entered at planned levels to control risk and avoid impulsive decisions. Third, target, locking in profits. Your target is where you take profit, also predefined. Setting a clear target in advance allows you to calculate your risk to reward ratio, ensuring you only take trades with a favorable outcome. Once you have established your stop, entry, and target, the best thing to do is set the trade and walk away. I call this the set and forget and get alive strategy. Place your trade in advance. Let it play out. Avoid emotional decision making. This method helps you eliminate impulsive reactions, stay disciplined, and master the psychological side of trade. By sticking to this approach, you manage risk effectively, trade with confidence, and most importantly, keep your emotions in check. Let's have a closer look at each element of a trade. The first key element of any trade is a stop. This is where we close and open position at a predefined loss. Rule 1. Placing a stop is non-negotiable. Every trade we take will have a stop, and here's why. A predefined stop manages risk with precision and keeps emotions in check. When you know the maximum loss before entering the trade, fear is reduced, and you can make rational decisions. Ideally, the potential reward should always outweigh the risk. That's why we apply the 33% rule for stop placement, meaning the stop loss is placed 33% of the width of the zone away from the distal line. Now, is getting stopped out a bad thing? Absolutely not. It's simply the cost of doing business. Think of trading like running a startup business. If you open a coffee shop, you will have monthly running costs: rent, wages, ingredients, and utilities. In trading, instead of these expenses, your running costs are losing trade and your revenues winning trades. What matters is a big picture. If at the end of the month, term, or year, your revenues exceed your costs, then you are running a profitable business. This mindset shift is critical. We are not playing a game of winning and losing. We are running a business where managing costs and maximizing revenue is a key to long-term success. Let's discuss the next key element of any trade: the entry. As we discussed earlier, this is a moment you open a new position at a predetermined price. A well-executed, pre-planned entry offers several key benefits. One of the biggest advantages is that it improves your risk to reward ratio. Proper timing helps you catch market moves at the right moment rather than reacting emotionally. This ties into fundamental concepts like supply demand, and unfilled orders, all of which we cover in detail later. Another major benefit is emotion management, especially during volatile conditions. Take the gold rush of 2024. Gold skyrocketed from $2,000 to $2,800. And many traders chase the price, buying at $2,500, $2,600, or even $2,700 US, not based on strategy, but out of FOMO, the fear of missing out. A pre-planned entry eliminates this emotional trap. Instead of reacting, you stick to your plan and trade only when conditions are right. Finally, a well-defined entry saves you time. Instead of staring at the screen all day, you can set your trade levels in advance and move on with your life. I love trading, but I also value time with family and friends. And a solid plan allows me to do both. Now, let's break down the different types of trade entries. There are three main entry methods, each with its own advantages and consideration. The first method is a proximal entry. This involves entering a trade at the very first opportunity when price reaches the zone. It's a straightforward approach and ensures you don't miss the trade. However, the downside is that price may penetrate deeper into the zone before reversing, meaning your stop loss must be placed strategically. The second method is a zone entry. Instead of entering immediately at the proximal line, you place your order somewhere inside the zone, closer to its midpoint. This balances entry precision while reducing risk, as it allows for some price fluctuation within the zone before execution. The third method is a confirmation entry. With this approach, you wait for price to reach the zone and then look for confirmation signals, such as candlestick patterns, momentum shifts, or volume spikes, before entering the trade. While this increases probability, it comes at the cost of potentially missing the trade altogether if price moves too quickly in your direction. Each method has its strengths and weaknesses, and ultimately, the choice depends on your trading style, risk tolerance, and strategy. Let us examine each entry type in a bit more detail. The first and most common entry type is a proximal entry. For a short trade, you place a sell limit order before price reaches the proximal line of the supply zone. Your stop loss buy stop order is positioned just above the distal line of the zone. For a long trade, you place a buy limit order before price reaches the proximal line of the demand zone. Your stop loss sell stop order is positioned just below the distal line of the zone. This entry method is the foundation of the set and forget strategy. Once you have set your entry, stop, and target levels, you let the trade unfold without constantly monitoring the market. This structured, hands-off approach makes it ideal for traders who prefer a disciplined and efficient way to execute trades. Now, let's move on to the next entry type. The second entry type is a zone entry. For a short trade, you place a sell limit order or a market order once price has already entered the supply zone and is showing signs of reversal. Your stop loss buy stop order is positioned just above the distal line of the zone. For a long trade, you place a buy limit order or a market order once price is already within the demand zone and appears to be reversing. Your stop loss sell stop order is positioned just below the distal line of the zone. This approach offers a balance between precision and confirmation. It allows you to react dynamically to price behavior within the zone, rather than setting an order in advance and waiting for price to trigger it. Additionally, by entering closer to the middle of the zone, you may improve your risk to reward ratio compared to a proximal entry, while still maintaining structure and discipline in your trading. Now, let's move on to the final entry type. The third entry type is a confirmation entry, a more conservative method that provides additional confidence before executing a trade. For a short trade, you place a sell market order only after price has entered the supply zone and then crosses the proximal line again. Your stop loss, buy stop order, is positioned above the distal line of the zone. For a long trade, you place a buy market order only after price has entered the demand zone and then crosses the proximal line again. Your stop loss, sell stop order, is positioned below the distal line of the zone. This method increases the confidence by confirming a reaction within the zone before entering, but it comes with some key trade-offs. Requires active monitoring. Unlike the proximal or zone entry, this method does not allow for set and forget trading. You need to be at your screen, watching price action and waiting for confirmation before executing the trade. Psychological pressure. If price enters the zone and starts reversing quick, hesitation can creep in. Traders may second guess their decision, either entering late or missing the trade entirely. Sticking to the predefined rules is critical to avoid emotional decision making, potentially worse fill prices, because you wait for confirmation before entering. The actual fill price might be worse compared to entering at the proximal line, slightly reducing your risk to reward ratio. For traders who prefer extra confirmation before committing to a trade, this approach is useful. However, it requires discipline and patience to execute properly. The final piece of a trade is a target. The target is a closing of an open position at a predefined profit, and it's just as crucial as placing a stop. Here's why. Setting a target helps control emotions, particularly greed. Without one, it's easy to hold onto a winning trade for too long, hoping for even more profit, only to see price reverse and wipe out your gains. By defining your target in advance, you know exactly what your potential reward is. This allows you to compare the risk you are taking against a possible reward. The risk to reward ratio. This ratio is one of the most important key performance indicators, KPIs, in trading, and should be monitored by you closely. Another approach to managing risk is using multiple targets. Instead of closing your entire position at a single target, you can scale out, taking partial profits as price moves in your favor while keeping some of the trade open for potential extended gains. A structured approach to targets ensures consistent profits, reduces emotional decision-making, and aligns your trading with a logical, rule-based system. Now, let's take a deeper look at how we determine optimal targets in different market conditions. Now let's jump into the charts for some practical application and apply everything that we have just learned. Welcome traders to my practical application. Today I will talk about the elements of a trade, where to have to move our stop loss, our entry, our target, and how to trade a level. Great, let's go into our Campus Fund trading platform. That's TradingView. We can execute and analyze all of our trades here. Okay, let's go with the Euro US dollar here on the daily time frame. Again, we will talk about the elements, the stop loss, the entry, and the target. Okay, let's identify a zone first. And we can do this with our Fibonacci tool, right? And let's go with a drop, base drop here. I'll go, of course, with the preferred version, okay? With the preferred version of our drop, base drop supply zone. Okay, I will enable also the magnet. And now we have our proximal line and our distal line. Our proximal line is always our entry here. I will go this, or I will change the colors here. Now, that's our entry. We will talk also about the 3 entry opportunities a little bit later. But let me continue with the stop loss. Where is the right place for the stop loss? Is it our distal line? No, it's always for supply above the distal. For demand zone, it's below the distal. And we have a general rule. We will add always 33% on top of the zone. But that's up to you. You can also go with 20, with 30, with 15. That depends on your trading style. But our rule is to add 33%. How to do that? Just enable the minus 0.33. That represents the 33% on top. You can see that, right? Our stop loss, the red line, is above our zone, above the distal. Okay. Entry is here, our proximal line. Stop loss above the distal line. What's about the target? Here, let me go. Daily time frame is our lower time frame here. Let's check the trend because we have a lot of rules, right? Let's go on the weekly time frame and you can see that's our higher time frame. We can use it for our direction analysis and it's a clear downtrend, right? Look at this. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs and new lower lows. And we are looking for a short opportunity, okay? Meaning we will trade the trend. We'll follow the trend. That's great. I'll remove this. And I'll go back to our lower time frame daily. And meaning we are following the trend and we are looking for a target from 1 to 4. Okay, let me add the short position tool. And here, our entry, this one is our stop loss. And let's check our profit margin. Okay, we want to follow the trend, meaning we're expecting a new lower low. And you can see it is only 3.72 reward. Not enough, right? Here we can talk about different entry opportunities. This one is a set and forget and get alive, right? You will set your entry here, stop loss here, and the target below. Let me enable the magnet. Yes. Okay. But we have also other entry opportunities to increase your profit margin. One of it is a zone entry, meaning we will not go with a set and forget entry here on the proximal. No, we will move our entry a little bit higher into our zone. Unfortunately, for this entry, we have to spend time in front of our screen. Okay, we have to wait. Let me move this higher. For example, here around 50% into the zone. Okay, but that's up to you. We have to spend time in front of our screen. We have to wait that price comes into our zone, a pullback into our zone. And yes, then we have to press the short button, the short market button. Okay, but here you can see we can increase our profit margin from almost 4 hours to 6.5 hours. That's great. We will not move our stop loss and the target is again the same. The third entry opportunity is a confirmation, meaning we will go with the same entry as in entry opportunity 1, but for that we have to wait. Let me show you this with a trend line. We have to wait that price comes into our zone, okay, pullback, and then we're getting filled when we get the drop, okay, when we hit our proximal line again. Then we get filled. That's perfect. Let's play this one out. Press the play button. You can see, oh, that was really quick. That was really quick, but we can talk about this. You can see we got filled here with entry opportunity 1. Of course, that's a set and forget entry. option 2 around 50%. That was around this. It should be 50%. You can see it never got filled, right? And with option number 3, yes, it got also filled. What is the reason for that? Look, the green candle, okay? I will add an arrow. You can see the green candle here, right? Hit our zone and then check the next candle, the red one. On the next day, we got weakness. And yes, this represents your confirmation entry. Yes, means in summary, with the first entry opportunity, yes, we got filled. That was here, right? With the second one, the zone entry, unfortunately not. And the third entry opportunity, yes, great. Here we never hit our target, right? We got a weakness, yes, that's fine, but we never hit our target. We never got a new lower low. We have also trade management rules for our stop loss. And here we are following the trend, okay? Meaning we have to move our stop loss to break even whenever we hit a 1 to 2. And let me move this higher to 1 to 2. That's here, okay, 1.99 almost. Then we have to move our stop loss to break even. Let me move this. I will change the colors to red. Okay, then we will move whenever we hit, that was at this point, our 2 to 1. Okay, then we have to move our initial stop loss to break even. We'll move it to our entry. Okay, also, if we talk about the zone entry, right, it was here. Okay, then of course we have to move our target a little bit higher, again to the 2 to 1. That's here again. Here we have to move our initial stop loss to break even. That's here. Okay, great. We talked about the entry opportunities. We talked about the stop, entry, target, and for the supply zone. Now we have to talk about the demand zone. Okay, another example and another time frame, a little bit lower. That's the S&P 500 on the 4-hour time frame. Okay, great. Here we have to identify our demand zone first. That's here. And guys, don't forget, it is always on the preferred version. Let me change the colors here. Then we start from the scratch. Great. Okay. This is our entry, right, on the preferred version. Proximal line represents our entry. Change this to green. Great, that's our entry and our stop loss. Again, we have a rule. We will add 33%, okay? Meaning you'll go with a minus 0.33. The line is red. Entry on the proximal line and our stop loss below the distance, below the zone. Great. What's about the target? Remember, our target depends always on the direction. That we have to go on the higher time frame again. Here we change from the weekly to the daily, and this looks like an uptrend, right? Low, high, higher low, higher high, higher low, and a new higher high. The idea is to buy in an uptrend, okay? Meaning we'll follow the trend. That's the same rules like before, okay? Remove this one. I will go back to our lower time frame zone. That's a 4 hours time frame here, meaning we need again a 1 to 4 profit margin. Okay, let me check the profit margin here. Long position tool. Move our entry again, or our stop loss to the stop loss position, and let's calculate this one. Oh, that's already 4. Great. Let me move this lower. Okay, that's perfect 4. We have more than enough profit margin, right? More than 4 already. Okay, here let's talk about the 3 entry opportunities. Number 1, of course, is a set and forget entry. We can go with a proximal line, okay? This one, here is our entry. Our stop loss is below. Option number 2 is a zone entry. Here again, you can move your entry into the zone really low or around 50%, right? That depends on you. You can maximize your profit margin, but you will decrease your probability to getting filled, right? And option number 3, by the way, for option number 2, you have to spend time in front of your screen again, right? To wait for the best moment and then to press the buy market button. For option number 3, that's a confirmation entry. For that, we will move again our entry here to our proximal line. Then we have to wait for the pullback into our zone. And whenever we get a rally from our zone again to the upside, then we get filled. Great. Let's check this together. I'll press the play button. It's always really fast. I'll go with 3 times. And look at this. Wow. Great. Here you can see how powerful it is to add the 33% to our zone. Look at this. You can see we hit already our distal line, but we have always a buffer, right? That is a 33% stop loss. And here that protected us for a loser trade. That's perfect. And then, yeah, we got a rally, okay, then a retest of the zone, and then all the way up for us, and also a new higher high. Perfect. The same rules like before, right? And if you follow a trend, okay, we can move our stop loss to break even at 2 to 1. Let me move the 2 to 1 here. It's here. Great. Okay, meaning we got the drop, we got filled with entry opportunity 1, okay, also with entry opportunity 2, for this example, around 50% into our zone, and as well opportunity 3, our confirmation, right? We got the drop and then we got the rally out of our zone again. Great. And then we have to go with change the colors, right? Whenever we hit the 2 to 1, right? And this was the moment here with this green candle, we can move our initial stop loss to break even. And that's here, right? That's our initial stop loss. We'll move it all the way up to break even. Perfect. Then look at this. Here we got a little bit sideways and another rally. Great. Now I talked about it, about the stop, the entry, the target, the entry opportunities. Let me show you how easy it is to set a trade on our Campus Fund trading platform. Here the Euro-US dollar on a 1-hour time frame, right? And let's go with the rally base rally here, for example, okay? It's so easy. We can go with a long position tool. That's your entry, right, on a preferred version, and your stop loss is, of course, below 33%, right? And your target is, for example, here. Okay, and let's show you. That's a right-click, create limit order, and then you can see, yes, the price is already here, the target is here, the stop loss is here. We just have to adjust the risk size. And here, let's go with a 0.5%, okay? And one click, that's it. So easy it is to set a trade on a Campus trading platform. Okay, traders, that was my practical application about the elements of a trade. See you in the next one. You have now learned the 3 core elements of every trade: entry, stop, and target, and how they fit into a structured trading approach. We covered the 3 types of entries: proximal entry, zone entry, and confirmation entry, each with its own benefits and trade-offs. You now understand when to use each based on your strategy and risk tolerance. We also emphasized the importance of a stop loss, not as a suggestion, but as a non-negotiable rule to protect capital. Stops ensure controlled risk and prevent emotional decision-making. Finally, we discussed the target, which is just as crucial as the stop. A well-defined target helps control greed, allows you to calculate your risk-to-reward ratio, and can even be managed using multiple targets for strategic profit-taking. By combining these elements into a clear, structured trading plan, you remove guesswork and emotion, setting yourself up for consistent and sustainable trading success. Thank you for watching today's lesson. I will see you in the next one.